We'll get started here in about 30 seconds. We appreciate you taking the time to be here. All right, everyone, I'd like to welcome you to the Trading Pub. We've got a great class set for this afternoon with a good friend of mine, Chip Frame, out of Chicago with Nadex. It's the North American Derivatives Exchange. And you know, it's kind of interesting. I was actually talking to one of our members this week that has a Nadex account, and he was telling me, he said, you know, I've been doing really well in my Nadex account, but I've been struggling with futures. And he's trading Nadex products that are based on futures. And I said, that's interesting you say that. And I said, I bet where the difference comes in is the fact that all the trades with Nadex have a defined risk and a defined profit, so you're probably sticking to your trades more as opposed to, you know, with the futures you're probably moving your stop, you're getting out early, getting in late, et cetera, et cetera. But it was really interesting to see that he had very, you know, it was very successful with the numbers and the terms of percentage return over the past several months trading on Nadex. And I think that a lot of traders benefit from that mindset of knowing, okay, you know, when I get in this trade, I've got a defined risk and I've got a defined reward. And I think it helps people to stick to the plan more so than, you know, when they're trading just in the underlying market of either futures or Forex or commodities or other markets like that. So again, you know, we've been a big believer of Nadex. We've been kind of preaching the good word about Nadex over the past 2 years now, and you know, continue to get, you know, great feedback from the people that get involved with them. And the thing that we really like about it is the fact that it's actually built for individual traders. So it's built for traders like you and me, not for the big, you know, hedge funds and automated desks. So Chip, I appreciate you being here, taking time out of your day to join us. And at this time, I will turn things over to you. All right, guys, give us 1 second. Chip will be on here. He's just got to get his mic turned on and get going.
Okay, testing. Testing.
All right, Chip,
You can hear me?
Yeah, hey Chip, we can hear you. You're good to go. Take it away.
Okay, you can hear me? All right, excellent. Then I will just take it away. Okay, thanks for having me today. And today we're going to talk about the Nadex spreads. The agenda today is kind of an overview of the Nadex spreads, a little bit about risk management. Then we're going to do some comparisons of using a directional trade, using a spot position and a spread trade, a comparison, and then also using the Nadex spreads as a possible hedge. And of course, we'll open it up to questions afterwards. Anyway, you've all seen this, risk disclosure. Trading can be risky. We've gone through this, or you've seen this many, many times, but you have to realize that the trading capital that you have, you don't want to be in a position where you're depending on that money. It's money that you can afford to lose, and you have to manage your risks, and that's one of the things I do like about these products that Nadex offers. So off the bat, I'm going to talk real quickly about just regular options, okay? Nadex products are options, but there's a slight difference, and I'm going to show you the similarity. So a long call P&L chart at expiration, we have the call strike. Obviously, there's a premium, but what's our break even? It's the whatever the premium is, plus the add that to the call strike, and that's going to be your price level at break even. Okay, so keep that in mind. Now, the chart's going to look like this at expiration: unlimited profit potential. Your premium is going to be your maximum risk exposure, and it's and then you start making money above the strike. Okay, so the Nadex spreads are basically a range. The durations are a daily, 2 hours, or in between. The risk is limited. You also have a cap on how much money you can make. You can go long or short. If I'm bullish, I'm going to buy the spread. If I'm bearish, I'm going to sell the spread. Okay? Each tick in a spread's $1. And remember, you can close out your position at any time. Okay? Okay, so let's do a little comparison of what the Nadex spreads look like. Okay? So here's the underline. You got a low strike, a high strike, there's the range. Okay, now the entry point where you're going to initiate the trade. All right? So the cost of that entry point, if you're a buyer, and we're looking at it from the long side, would be the low strike to the entry price on Nadex. That price differential it's $1 a tick, and that's going to be your initial cost. That's your break even. The trade price, your initial trade price, is your break even. So you see that relationship between the call strike plus premium. Okay? It's just a different way to look at it. Okay? So what's that diagram look like? Well, it looks like a vertical call spread. We are capped at the high strike. Okay, so here's an example of a Nadex spread using currencies. The Euro USD 136.70 to 139.20. This is a daily. The underlying spot is at 136.55, and the Nadex price, where we went into the trade, is 36.99. Now remember, 36.99 is the break even. That's where, if I'm long, I need the underlying to be above that at expiration. I'm making money. And remember, you do have a cap. If I'm a buyer, then 39.20 is my cap. Okay, so here we go. 36.99 is my entry point, but the low strike's 36.70, the high strike's 39.20. I enter the trade here. That's going to be my break even. How much does it cost? The low strike, 36.70 from 36.99, that price differential is $29. Okay, the range is 250. The total range is 250 ticks. That's $250. So of that range, my portion as a buyer, and that's the buyer's cost here, $29. That is my cost. That's my maximum risk exposure. My upside potential is going to be the remainder of that area up to 139.20, which is $229. That's, if I'm right, remember this is a variable payout at expiration. If the underlying finishes, if I have an expiration value of 139.20 or higher, my net profit's going to be $221. That's a 762% return. Okay? For the buyer. But that 221, this is a fully, let me backtrack. This contract is fully collateralized. So this 221 is the seller's cost. Seller's cost 221, $29 is the buyer's cost, combined is $250. So my profits are capped as a buyer at $39.20. $221 is the cap. Can't lose any more than 29. If it falls to zero, I can't lose more than 29. As Morgan was talking about earlier, you take this position, you don't have to worry about being stopped out. You're comfortable with the risk. You can hang in the trade till the duration is over, till the end of the day, 3 p.m. Okay? All right, so now let's take a look a little bit closer into this cost. Now, in between, it's a variable payout, remember? Above the break even, you're making money all the way to the cap. at the low strike to the break even, you're making it back. Okay, our entry point, our cost was 136.99 to the low strike, 36.70. Okay, seller's initial cost. Look at the portion of this out of the 250 range. Seller's putting up quite a bit more than the buyer. But this is the buyer's cost right here, right here. Now, where did we say the underlying spot was? We said it's 36.55. Okay, so right now, dollars cost, what did I have to put? The difference between 36.99 and 36.70. It's a cost, but there's an additional cost, the difference between 36.55. Right? That is 15 pips. Right? 15 pips. It's not costing you money, but that you need the underlying market to move an additional 15 pips before to get to the 36.99 before you get to your low strike. Right now, this as a buyer, it has no intrinsic value. Okay? Now, if we, let me show you here. Now, there's a good possibility I looked at the spot price wrong when I did this slide, because if the spot price was here, then this area right in here would be an intrinsic value. Okay? It would have to cost that because the spot is above that low strike. Okay? But when you're looking at this stuff, you need to take a look at the compare where is the spot position, where's the spot relative to your entry point. Okay? That difference turns out to be from the spot to the entry point is 44 pips. That's edge. Okay, so the buyer is giving up edge. The seller is getting that edge. So remember, here's your entry point, and if the contract expired right this second, well, the seller's got an immediate profit of the net difference, which I believe was $29. Okay? Okay, so here's another example. We're buying the Nadex spread. This is a different spread. Here, the range is the same as a daily. The initial price for where we initiate the trade is 36.84, but we're more in the middle of the range here. Okay? That's our break even, remember. The buyer's cost is the lowest strike to the break even, that's 139. Seller's cost is the difference, the price differential between the entry point and the high strike. Okay, again, fully collateralized. But now let's take a look at where the spot is. Okay, the seller's cost is 111 compared to 139. It's more evenly distributed. But the spot is 136.83. Minimal edge. Okay? And so the next couple slides here is going to this is going to make a lot of you need to understand the kind of the intricacies of how this relationship works. Okay? So here is a graph of the Nadex pricing, okay, which is actually the blue line, okay, and that is the midpoint of the bid ask of our pricing of the spreads. Okay, and this contract is actually the US 500. This is a futures. Okay, now there's right underneath there, which you can see some of these outer lines, the red and green line charts, and that represents the underlying indicative, which Nadex calculates. Okay, so this is actually the expiration value on an ongoing basis is what that's representing. So if we're doing a currency, this calculation is a 25 sample set, It's the bid-ask spread of say, the euros. It would have to be 5 pips wide requirement or less. You take out the 5 high, 5 low out, middle 15 simple average, and we carry that one more decimal point out. If you're using a future, it's the last 25 trades. Okay? But as you see, look how closely the Nadex pricing mirrors the underline. Remember, Nadex reacts to the underline. It's not the other way around. Nadex is definitely the tail, and the dog is wagging the tail. All right? Nadex reacts. Now, this is a very wide spread, so if the trade price of the underline is, or actually, if the trade price of the underline is within the middle of the range, or in the middle, and the wider it is, the more the tendency that there's going to be this high correlation where Nadex is tracking the underline. Okay? Now, here's another example. Here's a currency. Now, this is a 2-hour duration. This is 100 pips, 37.20 to 38.20. This is an intraday. It started trading at 9 o'clock. There you see the blue. Okay? And you'll notice the red-green line, which is, again, the Nadex continuous expiration value. There's a divergence here. Okay? Well, why is that? This is the low strike. As what you'll have is, as the underline gets closer to one of the boundaries, the low strike or the high strike, Nadex pricing will start to lag. Okay, it's a function of the instrument. Now at expiration, it is going to expire to the underline, that calculation that I told you. So when in the middle of the range, there's going to be a responsiveness where Nadex is mirroring the underline fairly well. But then as you go towards the outer bounds, then that's when the optionality starts to kick in and it starts to lag. Okay? So you do have to keep this in mind when you're trading Nadex. Okay, here's just another example of the divergence that you get towards as it approaches the strike. Now, as it gets to expiration, then it will converge and get closer and closer. But again, we are going to use the underline to come up with the expiration value. Okay. And here is just one more. I'm not going to bore you with it, but this is the widest currency spread that we have. This is 600 points. So when they're super wide, there's going to be a longer range area where it's going to be tracking the underline versus the divergence. Okay. So here's kind of the overlay how we do it here on Nadex. In the yellow, that's the big spread. That would be like that 600 point range spread in the euro. And then here at 8 o'clock, we come out with an 8-hour spreads, 3 of them. Notice here's the underline. We have one where it's trading right in the middle of the range, and then we offer one that the underline is going to be trading near the ceiling, and this one here is near the floor. So you have an in the money, at the money, out of the money spreads. Okay, choices. And at that same time, we did a 2-hour duration, okay, which is right here. The shorter the duration, the smaller the range, okay? 9 o'clock comes around, now we offer another one. Here's the underline, here's at the money, in the money, out of the money. But remember, we had another hour one going here, and there it is. So all these are choices that you can consider when you're trading these spreads. All about cost. Where's your pointer? Can you see the pointer now? Okay, right here, the brown ceiling and floor, the shorter duration. Here, let me see if I can. This is what I was talking about. That was listed an hour ago, and so when it's 9 o'clock, Okay, at 9 o'clock, this three ranges were offered. Okay? So it's just a continuous, ongoing, every hour they're listing more spreads to choose from. So all these are choices of risk to reward. Given your view of the underlying market, what makes the most sense? So it's just, but and you have to analyze it, and it's just it's good to know how these things work. Okay, so just real quickly here, so we don't get bogged down here, but just to show you the trading choices, some quick examples here. Let me get this out of here. It's 11:34 Central Time when I pulled these up. Here's an order ticket. This is a 2-hour one. This is basically an at the money. Okay, it cost me 48 to make 52. That's 108% if I'm right at expiration where it's 30, at the high strike 37.20 or not. And right now, the underlying indicative compared to my entry point, I'm giving up 1.4 pips. Okay, that's kind of, and it's an hour and a half option. Those are the thoughts you're thinking about. Here's another one. This is in the money. This is going to turn out to be 11% return if it finishes at 36.70 at the high, the max. Now it can finish lower than that. It's a variable payout between 35.70 and 36.70, but your break even is 36.60, your entry point. Now you're risking $90, 11% return, and you are receiving 6.9 pips of edge. Hour and a half option. That's the question. Does it make sense? Here's a 9 to make 91. This is a heck of a return, but your odds are against you. You're giving up 12.9 pips. Risk is $9, over 1,000% return. So, and here's one. The next day I pulled this one up, and this is a daily. Longer duration, you're giving up more edge, 43.25 pips. This is a 6 3/4 hour option. $29 risk. There's the potential return. These are the questions that are going through your head. Does it make sense or not? Okay? So risk management, swing trading, short-term trading. Our contracts are definitely short-term. The spreads are 1 day or less in duration. But you have to get a handle on the risk. It's where do you figure out where are you going to put that stop? And it can be difficult. You have to use a stop. But there's another way to manage your risk. And remember, it's never about just the one trade. It's the lifetime of trading. It's the conglomerate of all your trades. Okay? So let's take a look at just a regular spot position. Okay, here's the euro. Oops. We're going to get long the euro 130-200. Okay? I'm going to put a stop at 31.40, 60-point stop. Okay, that's where we're going to define our risk. All right, and let's let the market go. Here we go. Happy. All right. Let's do it again. We'll make another trade. Ouch. So we lost 60, but we made 120. We'll pretend that we got out on the perfect high there on the first part of it. But how many times does this happen? You got stopped out, but then it's in your face. Okay, here it is. We're using using the spot. Let's do a quick recap here. The first trade, we make 120 pips. We get out of that trade at 33.20. The second trade, we lost the 60 pips. We get stopped out. So the margin on that is 26.40. Reward to risk ratio is 2 to 1, and so our net profit is 600, and so our return here on margin is 22%. Okay? So that's a choice. It's all about choices. Okay, so now let's take a look. What if we use the Nadex spreads? Same idea. We're bullish on the euro. We like the euro at 130-200. So we take a look at the Nadex, and Nadex happens to have a spread contract where the floor is 32, ceiling's 33. All right. Sometimes these are referred, the Nadex spreads are referred as box spreads too. So the entry point on the Nadex is 32.15. Now remember, the spot is 32. So it costs us 15 pips to get in that trade. That means the remainder of this range, which would be 85, is profit potential. Okay, so here we let it rip. It goes immediately against us. But remember what Morgan was saying. 15 pips is my maximum risk. If you're doing a standard, that's 150. 10 contracts of Nadex equal a standard contract. It's $1 a pip. So this is giving you the ability to hang in this trade. It's in your face right now, but your risk is realized. You know what it is. You can wait till it expires. So here, scenario, what happens? Hey, I'm still in the trade. I could make money. All right, so let's review here. And on the first, let's say one trade we made the full amount, 85 pips. Remember, we are capped at 3,300. We don't get that additional 20 as we did in the spot. And for, just to be fair, we lost on the second trade. Okay? We lost on the trade, so we lost 15 pips. The margin required, these are fully margined contracts, 100%, so our total risk is 150. That works out to a reward risk ratio of 5.66 to 1. We're going to profit 700, so to make these, to have a standard contract, we use 10 contracts, so that's $700. Now we do have fees on the exchange. Okay, so 9 in, 9 out. Okay, so when you consider the fees, it's going to take us down to 673, and our return on collateral is going to be 449. Now, using Nadex spreads as a hedge, here's an interesting way where we can use the spot and still have unlimited profit potential, but also actually improve our downside risk with less money. Okay, so we are long the spot at 13200. Okay? And normally we'd have the 3140 stop, 60 points of risk, but we're going to use a different spread. We're going to have the spread of 3100 and a ceiling of 32. Okay, see it boxed out there? And it's going to cost us, our entry points are going to be 3185. Again, it's costing us 15 pips, the difference between 3200 and 3185. Okay? That's our cost, and that's our potential payout. So in effect, that 3140 now has moved the stop down to 100 pips. And using 10 contracts at 15, it only cost me 150. Okay? So here we go. Right now, the bad, here's the bad situation. Well, not a bad situation. Yeah, right now, it's before expiration. You have to figure, what am I going to do? One that you could leg out of this, you could leg out of it. And your cash position, you're taking heat, but you just made up a bunch of money on your spread. Now it's not the full 85 pips, but you can. But are you going to wait till expiration and you can just unwind the thing? Okay, it's a decision time. You have to figure out what you want to do here. All right. But again, you can if you let it ride. If we let it ride, here's what happened here. But at expiration, if the expiration value is at, you're covered down to the 13100 level. Okay, if it's below there, you're taking heat. You have a limit on how much protection you have here. Okay? So comparing the two spreads, or comparing the combo spread, you have the spot trade. We make 120 and we're giving up 15 pips. All right? 105 pips, that's 1,050. Net exchange, it's going to be 1,041. If where it expires at 3,100, at the low strike, basically lose 100. We lose 100 on our cash position. We make 85. It costs, that's a total of 150, and our net exchange fees, including the fees, it's going to be 168. So here's what it looks on the combo trade, and you can see it here, but let me, on the next slide here, this is where it really is interesting. So here's the spot position. Here's trading just the spread. Now, your return on margin here is pretty sweet here. But again, you don't have the upside. You are capped. Using the combo, where you're bullish, you're in the spot position, and you have that increased protection on the downside using the spread. It doesn't, your return on margin actually improves on these two examples. But again, it's the total trade, all the trades. Okay, and I think that is, every trade's different, but again, it's the total amount of trading. Okay. And I'm going to take questions in 2 seconds. We're almost done here. So remember, on Nadex, there's no membership fee. You don't have to buy a seat. If you're trading directly with exchange, all it costs is the deposit. The minimum deposit's $100, but in order to trade, you have to have enough money to cover that initial cost of the trade plus fee. And the fees, exchange fees, are going to be 90 cents in, 90 cents out. There is a $9 cap, so if I'm trading a 10 lot, it's $9. If I'm trading a 100 lot, it's $9 in, $9 out on the way. So if I trade a 100 lot in and out, round turn, $18. Okay, and expiration fees are the same. Okay, so let's see. Let's take some questions here. Okay. Now, if you're trading in the spread. If you win if it falls inside your spread by expiration. Okay. Your entry point, you're long or short. It depends which way you are. Now, you bought it at some price level, and if Nadex pricing is higher than where you bought it, you're making money, a dollar a tick. Okay? You can liquidate the trade anytime prior. Okay, so the tendency, remember that comparison that I'm showing, the indicative pricing, the Nadex indicative pricing for what the settlement would be compared to the Nadex pricing. Remember, in the middle of the range, they're almost laying on top of one another. There's a high correlation. They're almost mirroring. They're tending to mirroring. It's not etched in stone, but that's the tendency. But then when you get outside of the wings to the low strike, high strike, then the Nadex pricing will tend to lag. But at expiration, it's settling to the underline, okay, to that calculation, 25 sample set, okay? And if it exceeds the floor ceiling, you don't get if it exceeds the ceiling and you're long, you're crying. If it exceeds the floor and you're long, you're happy that you got this thing on. Okay, you just your risk is your premium you paid. Like regular option, long call, it's the premium I paid. If I do the Nadex spread, what's my cost? If I bought it, it's just like your premium you paid. Okay. Yes, it should be recorded. Do we have any more questions here? Let me run through these. Okay, so there is some videos on our homepage as well, nadex.com, and actually, you should check this stuff out at nadex.com, and there's education here, and there's some YouTube stuff as well. Okay, what are the hidden pitfall trading these? Okay, well, let me back up. It is a choice. Remember when I said we did the first one, we did the first spot position, and you did the spot position, and you're not giving up any edge. You're long at 13200. Okay? But then on the Nadex spread, if you're trading the Nadex spread, remember, spot's trading at 13200. You're getting long on Nadex at 3215. So you are, in a way, it's a call, a long call with a cap. It cost me 15 pips. And spot is below my break even at 32.15. Now, if I'm trading it and all of a sudden I'm going, hey, it's trading at 32.10, and I want to get out of the trade. I made money in the cash market, and I have not made my break even yet if I got out. And that's assuming at expiration. Remember, these are options, so it's not going to be a linear relationship to the actual underlying, to the Nadex pricing. Okay? So it's really just a choice. You're giving up something to have protection, where the spot, if I take a spot position here and I have my stop at 60 points, and I have one of these flash crash or in my face numerous times, I'm losing 60 pips each time. Here, I'm long at 32.15. I got 15 pips of risk, and I got one trade, and I plan to keep it on for the day, or whatever the duration. This would be 2 hours, this one. And that's the choice. To each his own. Any other questions? So if you do have questions, here's me, Chip.Frame at Nadex. I'd be more than happy to answer some questions for you if something comes to mind. Nadex does not provide signals. I have heard of people providing signals, but remember, these Nadex products are derivatives of the underlying. Okay, so it's your trading decision is really, do people provide signals for, the S&P or whatever? Well, then you can use those signals to trade on Nadex. It'd be with defined risk, defined payout. As an exchange, we cannot. Yes, Morgan.
All right, great. Thank you, Chip. We appreciate you being here for sure. And again, guys, if you go to our site, go to tradingpub.com, click free education, at the top, and I'll type this in, and then choose Nadex. There's lots of other videos that you guys can look at, and I can tell you I personally trade Nadex. I think it's a great market for individual traders. Trades pretty much 24 hours a day. They have a very cool app on your phone that you can actually trade from the app. As works very well, very easy to use. And so, Chip, we appreciate you being here. And also, because it is a new product, one thing that they'll do if you open a live account, they will extend the demo for a year if you send Chip an email. So you can send that to chip.frame@nadex.com. And I know LW has been a big fan of Nadex. He's in a lot of our presentations. He can tell you, the customer service there is really unlike any other brokerage firm that we've worked with or exchange. They do a great job of listening to the client and helping out. And Chip, I know, is even, I've even had people I've personally referred and said, hey, call this number, ask for Chip. And he spent 45 minutes on the phone with people going through the platform to make sure they understand it. So again, we appreciate you guys being here. Chip, thanks again. We'll get the recording posted on our website, and we hope you all have a wonderful evening. And again, here's the link. It's www.nadex.com. If you open an account and you want to get your demo set for a full year instead of the 2 weeks, all you have to do is send Chip an email to this address. All right, thanks.